Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Let me start by wishing all of you in advance a very, very happy Independence Day, where we've got special programming through the day for you on NDTV Profit, and hopefully you will enjoy it. My guest today on the show is Rushabh Desai, the founder of Rupee with Rushabh Investment. Thank you so much for taking the time, Rushabh. Always a pleasure speaking with you, and thanks so much for coming by to the studio.
Thank you so much.
I do want to talk to you about investments into the broader markets, and a lot of people, and this continues to be the case. I saw the data for the month of July as well, and there's a reasonable amount of money. Most money, of course, has gone into sectoral and thematic funds, but about 3,000 crore rupees or thereabouts has once again gone into mid-cap and small-cap funds. Why do you think that is?
See, it's all thanks to past returns, Alex. See, over the past 3 years and 5 years, the returns have been phenomenal. Like mid-caps and small caps have delivered more than 30% CAGR returns. Yeah. Now, when we go to our clients and when we say that, long-term keep your expectations moderate, the new expectation is around 20 to 25%, 30% CAGR.
For the corpus?
For the corpus, right? I mean, they expect now that kind of return. So this is the money, what you see, what has come in, it's all thanks to the past returns, what we saw, the mid and small caps, which have rallied substantially, Alex.
Okay. But then you've done a study, and I found it quite interesting. The underlying, ultimately, the markets follow earnings, right? Or expectation of earnings. And the reality is that while the larger companies have delivered according to expectations, the broader markets have disappointed to a large extent. What can you tell us about what you found?
Alex, that's a very great question. See, if you see the large cap segment, over 19 months, from Jan 2023 to July 2024, 19 months, large caps have delivered around 42% returns in absolute terms. Now, if you see the earnings, underlying earnings, the earnings have been around 33.5%. Right. So we can fairly say large caps are reasonably priced, and the price growth has been in line with the earnings growth. Now, coming to mid and small caps, Alex, from the same period, 19 months, Jan 2023 to July 2024, over 19 months, mid and small caps have delivered between 80 to 90% absolute returns. Okay. Right. Now, if you see the underlying earnings growth, Alex, the earning growth has been anywhere between 6% to 13.5%. So now this price growth, what you see in the mid and small cap, this is purely liquidity push.
Okay. When you say liquidity push, what do you mean?
See, liquidity push means like investors are pumping in money. See, today the SIP, monthly SIP size is 23,000 crores.
Net is about half of that.
Net is half of that, that's fine. But if you see the DIIs, FIIs and the retail segment, it is more than 20,000 crores, Alex, which is coming in the Indian equity markets. Now, when so much of money gets pumped in, automatically there is going to be a huge demand. Right, and the prices are going to go up because fund managers will want to buy. See, fund managers today are not sitting. There are very few fund managers which are sitting on decent amount of cash, right? Usually, most of the funds are like invested 100% or close to 100% in that sense. Of course, they do have 5-10% cash. That's very separate. But when there is so much of inflows and the fund managers need to buy it, so they, even at a premium, they have no choice but to buy it at a premium. So what I mean liquidity is that so much of money is coming in, and because of the money coming in, fund managers are forced to buy at a premium price today.
Okay, and that is the case in the broader markets. Obviously, the point that you're trying to make, and you made already on the earnings front, is that valuations, particularly in the broader markets, are stretched. They're not keeping pace, or rather earnings are not keeping pace with valuations. So a couple of aspects to unpack here. What are fund managers themselves doing in the portfolios that you have studied? Are you seeing examples where there is rotation taking place?
So I studied 3 categories, Alex. One is value contra, one is focused, and one is flexi cap. So all 3 are very flexible in nature. See, I'm not factoring the multi cap, because in multi cap, you are 50% has to be allocated in mid and small cap, 25% in mid caps and 25% in small caps. Now, the average large cap exposure in these 3 categories is around 58-59%, okay, which clearly indicates that the fund managers are tilting towards large caps. Of course, there are exceptions where there are other funds where there have been heavy on mid and small caps, but there are good funds, say for example like Parag Flexi Cap Fund and other prominent like HDFC. For example, Quant has been very active. Their portfolio churn ratio is actually 400%, right?
And they've moved towards large
They've
cap?
moved towards a large cap. They are flexi cap fund, they are focus fund, and they are value fund. They initially, when I studied the portfolio, say 19 months back, they were heavy on mid and small caps. Now today they are heavy on large cap. This clearly indicates that today fund managers are more comfortable towards large caps rather than mid and small cap.
I was actually, and my team here has pulled up some data points, and I will share that with you. In the mid cap and the small cap categories, so I look at mid cap first, where there hasn't been a very substantial tilt towards large cap. In fact, in July of 2023, for mid caps as a whole and all mid cap mutual fund schemes, it stood at about 15% for large caps. That has actually fallen and come to about 12.2%. This is based on ESMF data. Mid cap allocation has gone from 65.9% to 67%, and small cap has gone from 14.7% to 17.1%. In the small cap category, you have an increase broadly in the large cap, but not to a very large extent. It was 5.3% a year ago. In July, at the end of July this year, it stood at 7%. So that's an increase of about 1.73 percentage points. Mid cap is reduced from 15% to 12.8%, and small cap has actually gone up from 72.6% to 76.1%. But this is as a category as a whole. What does that tell you?
See, when you venture into pure small cap and mid caps, right, you have to take it like, say, the fund manager is going to invest like 100% in pure mid, because that's a mandate.
True to label.
This true to label, and it has to be true to label, Alex, right? See, that's the reason why you have different categories, so that you can mitigate your risk in a better way. See, if you, when we tell our clients and when we construct our clients' portfolio, we always tell our clients that, you know, have some exposure in mid cap, small cap. I'm saying pure because, see, multi cap, it's a little rigid in nature. But when you have a combination of flexi cap funds, mid cap funds, and small cap funds, you have the liberty. See, when the valuations get expensive, then I can take more exposure and I can invest more in the flexi cap focus or value segment, right? I can't do that in a multi cap fund because the multi cap goes in all large, mid, and small cap. Right?
But I was only asking from the perspective, and this is a thought that I had, which is why I asked my colleague to pull up the data, which is that you have 65% that has to be allocated in both small cap and mid cap to small cap and mid cap respectively. The rest of the 35% can be allocated as per requirements, and one would assume that if fund managers themselves feel that there is a lot of froth, that valuations are stretched in the broader markets, they would shift out and protect the gains that they have made by deploying in large caps. That doesn't seem to have been the case. However, there are a few exceptions, and we've also pulled up individual scheme names where there has been a substantial shift. Let's try and pull that up as we speak about it. And in fact, in the mid-cap category, the schemes that have had a dramatic shift between November and March, November of 2023 and March of 2024, you have Mahindra Manulife, which has moved from 7.8% to 20.2% in large cap. And you have a substantial shift also in the, or rather that's the most substantial shift. The others are not as much. HSBC mid-cap as well as Baroda PNB Paribas has also seen an increase. In the small cap category, you have ICICI Pru that has gone up quite substantially from 1.6% to 9.1%, which is quite a dramatic shift. Mahindra Manulife once again has nearly doubled its holding of large cap. Kotak has also done an increase, and Axis has done an increase, but not to that extent. So there are a few fund managers that are reducing seemingly the amount of risk by shifting towards large cap.
See, Alex, value strategy funds will always be valuation conscious. Okay, so for example, like ICICI is more of a valuation focused kind of a fund. It's not growth oriented. Growth oriented will be always aggressive, Alex. So which is like Axis, Kotak, these are all growth oriented products. Okay, so you also have to understand what is the strategy of that particular mutual fund. See, just because you are seeing a shift within the pure mid and small cap category, that's no one clear indication, because every fund will follow a different strategy, right? So it's, I would actually rather bet on a product which is true to its label. You know, see, if I'm investing in mid and small caps, I want my money to go purely in mid and small caps. I don't want the fund manager to take, large cap exposure.
Fair point. A couple of quick questions to complete this conversation, and then we'll move to queries after a very quick break. But if you have made substantial gains in small and mid cap, investments that you're making, it is likely that your portfolio has gotten skewed as well, right?
Yes.
Because of the outsized gains. Is this the time that you rebalance, and what do you do with incremental monies that you are investing? You have SIPs running. Should you tweak that at all, or is it okay?
Alex, this is a great time to rebalance. See, if my original allocation to mid and small caps was say 50%, okay, and if the 50% over the past 3-5 years shifted to probably 65-70%, then coming back to the original allocation, say around 50%, makes more sense. But again, see, it also depends on the time horizon also.
Right.
If my time horizon is longer, see, if my time horizon is 10 years, then I would just let it grow the way it is.
Sure.
Right? I would book profits in two aspects. One is that if I'm not comfortable taking too much of risk, and second, if my goal is coming near in the next 6 months to a year. But if my time horizon is furthermore, say more 3 years, 4 years, or 5 years, then I
won't touch it.
I won't touch it.
What about incremental money?
See, incremental money can go into large caps. That is what I feel, because see, although we are seeing a sentimental drive or a sentimental upside, we should try and stick to the facts and figures of the underlying markets, because when I'm venturing into mid and small cap, my expectation of returns are always going to be higher. So if someone is investing today in mid and small caps, then of course keeping returns expectations low and moderate makes more sense. So if someone is rebalancing, incremental money can go into large caps. I'm not comfortable putting in fresh money in mid and small caps.
That's a fair point. Let's talk about the questions that have come through, and there are some very interesting ones. I will start with the first one from Vishal Nair, who is 50 years old. He's asking about what he should do at retirement. He's saying, will it be advisable to plan my retirement with an SWP structure, which is a systematic withdrawal plan structure, assuming an 8% return on my rolling mutual fund portfolio? And he's listed his investments. He's got a Nippon large cap, HDFC large and mid cap, Kotak Multicap, and SBI Contra Fund. More than anything else, Rishabh, it is the strategy that he wants to employ. And incidentally, we have discussed it in the recent past, the fact that it is actually quite a tax efficient manner in which you can pull your money out.
Absolutely, Alex. I think the funds what you have chosen are very good, well balanced, well diversified. I would, on the other hand, encourage him to introduce one value-oriented fund, because what I understand is a growth-oriented portfolio.
Sure.
So since recent times, value has done phenomenally well and growth has underperformed. Although it's very good to be in growth, around major allocation has to be in growth, but some flavor of value balancing between both the strategies is also very important.
So what would you say that he should look at?
Introducing one value fund. I think, see, he already has SBI Contra Fund. Introducing one more value fund, either HSBC value fund is something what I can recommend. So it gives a little bit of balance between growth and value. I think 8% is a very good figure. He's keeping his expectations very moderate, Pulling out money on an 8% annualized basis is absolutely perfect. Continue the way it is. I don't see any changes needed over and above the addition of the value fund.
Okay. Abhishek is 32 years old, and he's saying that he currently invests 16,000 rupees per month in a few schemes. He's listed them out: the Quant ELSS Tax Saver Fund, the HDFC Index Fund. I would assume that this is a Nifty 50 index fund, if not a Sensex fund. Both of those are available with HDFC. So he's mentioned, okay, it's the Sensex plan. We've got the Nippon India Small Cap Fund and the Edelweiss Small Cap Fund. He has a 15% annual step up. The tenure that he's looking at is 20 years. Is he on the correct path? Again, this is a very well thought out, interesting question. What would you say?
So, assuming 12% CAGR returns over the next 20 years,
right.
See, he's going to accumulate around 1.5 crore of rupees. I think that is something what I can say in terms of calculation wise. He's not mentioned his actual end goal, how much he requires. So at the end of 20 years, he can expect 1.5 crore. With around 15% SIP step up, it will be a good growth or good value addition, in terms of growth towards end of 15 years. See, one small change I want to make in his portfolio. He has 2 small cap funds.
Yeah.
See, Nippon India small cap has grown to a substantially large small cap fund. It's more than 50,000 crore. Yeah. And the maximum allocation in that fund per stock is around close to 2%. So now it doesn't add any value.
And 200 stocks is something
Yes, 200
like that,
stocks. Right? It's like over diversifying your portfolio. So so the churn is also restricted, and the growth upside opportunity also can be restricted from this point of time. See, since he has Edelweiss Edelweiss small cap fund, let him be invested in that fund the way it is. On the other hand, I can suggest him to go into Kotak Emerging Equity Fund, which is a mid cap fund, because he does not have a mid cap fund. So having a good blend of large, mid and small cap would do great.
Just a quick follow-up on that. He's mentioned the Quant ELSS Tax Saver Fund. Right now, of course, the old tax regime still exists, but somewhere down the line, if that changes, and also the idea of doing an SIP in an ELSS fund, is that not a great idea, because every installment gets locked for a period of 3 years?
No, on the contrary, it is better.
It's better?
Better, because
okay.
See, lock-in does not encourage you to pull out your money.
Fair point.
Right? So don't go overboard. Right, whatever the tax limit is, like 1,50,000 per financial, just do that. Maybe you can introduce one more flexi cap or a focus fund. That's different. But I would encourage him to stay invested the way it is in ELSS, because it has a lock-in, so that you don't get tempted to book profits and move up.
That, and also the tax advantage to the extent of your slab rate, right?
Exactly.
All right, we'll take one more. Sridhinath has got a question. He's 26 years old. He's saying that he has invested in the Edelweiss liquid mutual fund and Union liquid mutual funds for the last 3 months. He's not sure when to pull them out as it is in the liquid fund. Is it for the short term? What should you do with this? Okay, so I think he needs to understand what these funds are generally used for. And traditionally, Rushabh, it was used for parking for the purposes of your contingency fund or your emergency fund. Of course, a lot of people are moving towards arbitrage. Is that something that you would advise as well?
No, for short-term purpose, I think liquid funds are great. It's great. See, liquid funds basically invest in 91-day papers. Okay,
sure.
So keep
and by paper, you're talking about commercial papers, and you're talking about certificates,
the underlying instruments.
Debt.
Right, debt. Right. Perfect. Right. Yeah. So your money is safe and sound in that sense. Yeah. If you have a little bit of a longer time horizon, say 6 months or so, then arbitrage funds make sense, because arbitrage can get little volatile, in 2 months or 3 months basis. So if you have 3 months time horizon, then stick with liquid funds. 6 months, then maybe 6 months to 1 year low duration and arbitrage fund, and more than 1 year short-term debt funds he can look at. But I don't know what is the purpose of, because liquid funds are also used as STP,
right.
Right. So investing in liquid.
So let's spell that out. Systematic transfer plans, where you're strategically, if you've got a lump sum amount of money, you will put it in a liquid fund, and you will then transfer it into the equity fund or a balanced advantage fund. Absolutely. Or certain other fund. Is that something that you employ?
Absolutely. See, I mean, today, if I have a lump sum amount of money, and if markets are expensive as we speak today, then of course doing an STP makes more sense, Alex, till the time the valuations are stable. Also, the STP makes sure that your corpus is not lying idle. It earns some amount of money.
Yeah.
Okay. But again, this has to be, liquid funds are mainly for absolute emergency. If you have a 3-month time horizon, beyond 3 months or beyond 6 months is then low duration or short duration fund, something what I would recommend.
Okay, and I guess the other advantage is that you can pull money out of liquid very quickly, right?
Absolutely.
I understand that it's T+1 if I'm not mistaken?
T+2.
T+2, all right. Yes. No, but I thought liquid was faster.
We'll
have to check that.
I will need to check, yes.
We will have to check that. Rushabh, thanks so much for joining in. Pleasure speaking to you as always, and particularly on the Mutual Fund Show.
Thank you so much, Alex.
All right, that last bit, we will get that checked and get back to you on the next episode. For now, thanks so much for joining in. Do stay tuned. This is NDTV Profit.